Last night, NVIDIA reported a record-breaking $44.1 billion Q1 revenue. It was fueled by surging AI demand, even as it braces for an $8 billion hit from new China export restrictions. Despite the headwinds, shares jumped 5% in after-hours trading last night. I think the chairman's just kind of said, we own the pick, the shovel, the mine, you name it, we own it. So there's a lot of momentum behind that Blackwell chip. Let's break down these earnings and look at a few option plays as well after the bell. Hey, I'll have my cowboy. Background.
Like three genres of music. It's like whips you around.
I know. Good morning, boys. Big earnings today. In I always say NVIDIA wrong. It's not NVIDIA, I always say, but it's actually NVIDIA. So NVDA. There's no I between the N.
Yeah, there's no vowel between the N and the V.
Yeah, I know. Okay, so this is a big, this is one of the bigger earnings kind of stocks. It's like a fangy kind of stock, right? You want me to go through the summary of it real quick? Should we do that? And then we'll start talking about why Mark never wants to play earnings and options. Just kidding.
Sure.
It might not be just kidding. All right, let's do it. So revenue, this is Q1. Expected 43.3 billion. It hit 44.1 billion. That is up 69% year over year. Adjusted EPS, earnings per share, expected 88 cents, actual 96 cents, excluding a $4.5 billion charge. The data revenue center was expected to do 39.2 billion. It did 39.1, so slightly lower. Gaming revenue was a $33.8 billion number, and that 4.5 Q1 charge, and there was an $8 billion Q2 forecasted loss as well. All this was baked in, and they still killed it. So, by and large, these were fantastic numbers for them, really were, especially with the headwinds. With all the tariff stuff, they just killed it, right? Any comments, boys? Don't all jump at once.
I mean, I guess NVIDIA is it now the most, is it the highest market cap stock now again, or?
That's a good question. I don't think I know the answer. Let me find out. So it was fighting with Apple too, right?
Yeah, it fights with Apple all the time. And then the occasional Tesla pops its head out of the water and then dives again. But I don't know. NVIDIA
bigger than Apple. I see Apple is 3 trillion and NVIDIA is 3.4 trillion.
So it did surpass. It's probably today. It probably definitely did, right?
Yeah.
Although Microsoft's 3.42.
Yeah, it's getting up there. All right. So these are great earnings. Let's have the debate. Okay, we're ready for the debate. The debate is as retail options traders, do we suggest trading earnings or not? Mark, I know where you stand. I think your answer is no. Jason, I'm not sure where you stand. My stand is that I love trading everything, including marbles. So I probably have something on, but we'll talk about that in a second. Okay, so who wants to go first, Mark or Jason?
I mean, I could go first.
Okay.
Suggest is a very strong word. It's even if I wasn't an RIA, and talking about recommendations and stuff, suggest is it's a little bit strong for my taste. I think that you have to have a very firm footing in either the fundamentals or what actually is driving the flows of the stock. Yesterday, you said the stock moved 5% up, and the expected move was something like 5.5%, 6% or something like that.
Yep.
So there, as Mark is probably about to tell you, somebody knows more than you, more than likely. So if you do play it, make it, measure it in bips, not in percents in your portfolio.
Okay, fair. And what does that exactly mean, just for the folks?
Oh, so bips, basis points are like 1 basis point is 0.01%. So, if you put in like 0.25% of your portfolio, that's 25 basis points, or I guess we call it bips.
Bips. Got it.
BPS.
All right. Mark, any thoughts there?
Yeah, I totally agree with that last point. I guess I'd recommend trading earnings in the same way I'd recommend going and having fun at the casino. That essentially these things are incredibly fairly priced, like thanks to all the traders, all the retail traders, all the liquidity providers, like markets are very efficient. And so you don't know more than anyone. I can guarantee you that. And if you are going to trade them, it's, the same thing as having a hunch on black. And if you treat it like that and you want to have a little fun at the table, like nothing stopping you there. I think it'll engage you to other strategies. I think the main benefit of trading earnings is to understand the way options move. I don't think the main reason to trade earnings is to make money.
Okay, that's interesting, you big party pooper.
I think he said to have a party.
I'll even give you a more layered answer that'll speak to both the name NVIDIA that we're talking about, as well as both of your Catholicisms. And so the reason not to trade earnings is because of the cardinal sin of envy. And you do not want to have envy about what could happen with the market, or you're envious or desirous of like some outcome, but you don't know anything more. And that's actually the etymology of NVIDIA, is that it comes from the Latin word invidia, that means envy. And when they were looking for names, they wanted something that began with NV, which stood for next vision. They threw in the vid in there because of the focus on graphics and video, and that Latin word envy because they wanted to make their customers green with envy over their, success.
I did not know that.
I did not know that. That is amazing.
You like that little bow?
That is amazing. Unbelievable. All right. So I'm going to give you the Party Pooper Award for don't trade earnings. I know the retail folks like to trade earnings. I totally understand where you're coming from on this one, and not wanting to trade these for the reasons you gave. I think that's all valid. In the day, I think we didn't have a choice. We had to trade earnings, and we didn't have a choice of what we got. Technically, we just had the we had the price wall. But what I see from the retail folks is I see people have opinions, and again, it's black versus red. I get it. They're bearish or bullish based on whatever XYZ reasons there are. Are there certain sort of setups that we can do with options to take advantage of someone's fervent belief in a bullish earnings call or a bearish earnings call? I have a few examples on a bullish one and a neutral one. Can we look at these and see?
Yeah, let's look at it.
All right, let's have a look at the screen. I've got Tradier Pro up here. Can we see this? Yes. Okay.
Mm-hmm.
All right, so here's what I did. I did 3 different plays. Okay. I did a double calendar. What is a double calendar? What I did was, this is my not knowing which way the earnings would send the stock. I have no idea. I'll take both sides. So what I like to do is I like to look at the closing straddle the night before. So it's not today because we're already trading. It's the night before. And I'm trying to share my remarkable, but it's not working. So I'm going to have to explain this without showing you. But if you look at the 135 strike, that's where the stock closed last night. And we definitely want to be in that front month. That's where all the volatility was. And don't forget, we were looking at the 135 strike last night. Okay. And where that priced out was for the straddle. That's buying the call, buying the put together, add them together, was about $8.80. It was actually $8.80, about a midpoint. Call it $9. Again, don't have to be perfect. Just get close, dropping grenades. It made the move, expected move, about 143 to the upside if you add that $9-ish to 135. And, it's actually 880 and about 126 and change to the downside. I chose 143 strike upside, 125 strike downside. I want to sell those because I was taking advantage of massively high implied volatility. Today it's come back down to 63. It was 140 at the close last night. Second month was about 67, I believe. It's 44, which is about an expected value for it to go back to. Okay. So the sum of those volatilities is some fancy number, which I will compute for you in another time because we're making that mathematical change in Tradier Pro. So you'll be able to see that on the fly, what you're buying, the implied volatility or implicit volatility. Anyway, it's lower than what we think. Probably not low enough. And Mark's going to argue that you got your move, you SOB, so you should win, right? Because I went right to the 143 strike, pretty darn close. So what did I pay for this whole four-legged spread? I'm selling the front strangle. I'm buying the back strangle, same strikes, right?
Okay.
Any ideas of what I paid for all that? Ballpark? You would expect to know. I mean, just a total guess.
Yeah, I don't know. I'm looking at what 135 is right now.
Yep.
So I would guess you paid about 70 cents.
Okay, I paid $1.30. Okay, so it is what it is. Well, look, this is it right now. This is the spread right now. It's only trading $1.80. I was pretty right, and I'm only getting 50 cents out of this.
Mm-hmm.
That's not so great. Now the bad news is that, or the good news is that if it kind of hovered in the middle and I didn't get the move, you're not going to lose a lot either. So this is a very safe play if you have no idea which way it's going. You're going to make a little bit. You're going to maybe lose a little bit if you don't get the move. So is this a good play or not? It's safe. Let's put it that way. You have a pretty good chance if the straddle is pricing this move right to get a little bit of money out of it. Now
that you got your move, how are you managing the trade?
Well, what I like to do here is if I can get out of, let me just take two legs off. Two legs off. Okay. So because time's gone by, it's not up at the 143 level. It's not as good. So what I like to do is I paid 130 for the whole four legs. If I can get out of the good side for much more than 130, and it's 160 right now, roughly, right? That's not, it's 30 more cents. I'll take off that leg and just leave the downside leg on. I'll leave it because I could get a move back down. And I could get out of both sides for a profit, right? And for me, it depends on how big this one leg is. I want a good 60, 70%, plus on that one leg to get out of it, right? And I'll get out. And then I have a free play for the rest of the day. Even if it goes to zero, I still win, right? Does that make sense? I mean, you might not agree with it, but it makes sense, I hope, the way I explained it.
I mean, yeah, it makes sense.
Okay.
You just didn't make much.
Yeah, exactly. That's my point. It didn't do great here. It won, but not great. Now, the other play was, I can't remember which ones I did. Let's do this one. So this is someone calls it the exploding bull spread. Okay. Now, what is that? Anyone? Bueller?
Sounds like somebody needs to go to the doctor.
Is this like a slingshot kind of thing where you sell
perfect, Mark. So people called it the slingshot. So what I did here, and this was one of Brian's suggestions, I don't think I got it exactly right. And I can't remember. I'm doing the strikes now. So this is what I did here. You can see where it's trading 133. Again, this is bullish. This was directional. I had an opinion. So this is the very safe play. I did this for 50 cents. Okay. And I was right on the direction. And what I did was the slingshot, to Mark's point, is I sold a put spread. So I got a put credit spread, which is bullish. Okay. And the exploding put bull spread, or whatever you want to call it, means that I added a call with the credit from my put spread to defease some of the cost of buying that call. Why do we do that? Well, this is a big upside potential, right? It's an infinity one. I'm paying for the upside by selling this put spread. I have a nice cheap call now, and if we get a monster breakout, 30-point move, we kill it, right? Because we're naked long a call. Make sense, right? So this one, cheap play. I'm making $1.33 on a 50-cent investment. You know, it's moving around. Actually, it's $1.44 now. So, you know, I mean, that's good return, good percent return on this one, right? So
yeah, I mean, I like this kind of trade-off. I think that's what options are incredibly powerful at doing. It's important to remember the opportunity cost here, though, right? Because on the losing side, like, you didn't get that credit. You traded that credit away for like an upside call that's now worth nothing. And so you don't have the credit to compensate your chance of loss on the downside. So when it does go against you, you have no premium to collect, and you have the full width of that, $4 spread that you're exposed
and then
to.
that's a great point. And I don't know. So
yeah, I mean, I was about to say the big thing on this one is that Gamma is working either really for you if you're right or really against you if you're wrong.
Correct. So don't forget the max loss here, and let's explain it in terms. And Mark, you just touched on it. You are short a put spread for a value. So if I take out the call part of this, let's see what that put spread would, was. I can't remember actually. It was like I want to say it was like 50 cents thereabouts. So I've got this $4 put spread that I can lose. Let's just call it, $4 ish on it, right? $4.50. So I can lose $4.50 there, right? I also have a call I can lose on too, right? If it goes against me. So that's my downside. It turned out to be about $4.50 altogether. Thereabout. My max loss, I think I looked at it, $451.50. That was the max loss on the whole deal. That's on the downside play if I'm wrong, and that's what you were referring to, right, Mark?
Mm-hmm.
Okay. So that's a cheapie. The one I like better, because I like taking a little more risk, especially when I feel pretty strongly about my bullishness, is I did the third version, which is the big boy. Okay. So the big boy, let me see where this stupid thing, I keep putting them in the wrong month for some reason. All right, let me fix it. Hang on. I did the synthetic long stock, right? And I bought a protective put. Okay. Very similar to what we just looked at, except I put my call in the same line as my short put. So let's take one thing away. We're going to take that long call away, and we're left with a short put spread, number one, right? When we add the call, we're adding it to the same part of the put. So this long call short put is a synthetically long stock. It behaves exactly like long stock. Forget about this put right now. The reason we add the put is because you're naked short a put, and that protects you. So you get into the same exploding bull spread, but it's going to feel a lot better to the upside. And what does that mean? Probably a lot worse to the downside. So I did this one cost me $2.65, this whole deal. So much bigger than 50 cents, right?
Yeah.
So that one was bigger. Now, again, at 143, this was trading at $8.50, $2.65 investment. It's now back down to 573. I still got money in it, but we didn't close it out, right? So $8.50 is what I marked for where that thing was trading. And Mark, if you want to take a shot at explaining the difference here relative to what we did, have at it. But you can see how more powerful this one is, but you have a much bigger downside. Yeah. Any thoughts, comments, phrases, anything?
I mean, in some way, I like it depends how you want to define safer, but maybe this one has a little bit more of a predictable outcome, in that, you kind of have a very linear stock position result up to your protective, buffer level, or not even buffer, like floor on your risk. Yep. The thing that probably makes the slingshot a little less intuitive is that you've got a lot of gamma to that trade, and that that's going to be either not all that interesting, pretty bad, or really good, really fast if it hits something.
That's right.
That's like a little bit harder of a position range of outcomes to model in your head. Yep. I think.
So yeah, and that's a great point. You're good, Jason. Sorry.
Yeah, not just with gamma, but the thing that you were taking advantage of in your double calendar was the deteriorating implied volatility on that front month. You're getting hit on that in this trade. So you're unless it's going well above, unless you're predicting it going well above the dealer projected, range.
Yep.
Unless you're going that far up, personally, I'm not a big long gamma guy when it comes to earnings. I try to avoid that if I can.
Yeah, that's fair. I mean, because you're paying so much for it.
Yeah.
Don't forget, these plays are both bullish. The last two are both bullish plays, right?
Oh yeah.
So it's for the person who has an opinion about which way NVIDIA is going to release relative to earnings. So these are bullish. And this spread, it's trading 135. The break even is 137 and change, right? Where we did it, 137.65. So not too big of a move on an earnings play that's predicting $8.80 for the move, right? Now, if it went down, you're out, you're done. So I guess my point is that for I could the other spread I was going to lose 465 or what thereabouts 450. This one I'm only losing 65, but my upside's so much better. So I'm torn. I like this a lot. I do this play a lot. It's the synthetic long stock with a protective put. I don't know. And Mark, you call it a slingshot. There's all kinds of names for it, but I like this play.
8.
Say again.
You had so how much did you pay for this?
265.
And then you had a 5 point, basically a 5 point.
I always go 5. Vertical. I go 5 strikes down.
So if you had a 5 point put vertical, basically you're in for like 7 something, right?
No, because I had a big credit and I didn't pay as much for this side. So this was basically about even in terms at the time. And then I paid whatever the cost of my put was what I paid for it. So
it was like $2 something.
Yeah, 265 thereabouts.
But if the market goes down, then you could lose up to 5. So this is
the market goes down, I can lose my $7. So that's
what I meant. Yeah.
Yep.
So I think like this is a good move if you're expecting it to go above the dealer projected move. And usually in like very liquid stocks, very liquid option equities, like NVIDIA, you're not going to get that very often. Like Mark said, it's priced pretty well for NVIDIA. Right. I mean, my preference is if you're bullish on something like this and you want to take advantage of the reducing IV.
Yep.
I like butterflies myself, like a butterfly at wherever, I mean, I use Voland and I determine my pricing there, but a lot of times the Voland price and the dealer implied price tend to be the same. So, they price it well. So I do a butterfly. Usually I would do it around 143. So have a short strike at 143, have long strikes, 5 points surrounding it.
Yep.
That's like my preference on doing any kind of earning.
What I was going to say relative to this synthetic with a protective put, it's a super cheap way of getting long stock, quite frankly.
Yeah.
Like when we had the tariff noise and the market got clobbered and everyone hated Elon because now he liked Trump and he wasn't the big guy who was saving the planet from fossil fuels. They hated him and they hated his stock. I said, this is a bunch of BS. I'm long Tesla. I want to be long it. I did this, when the stock was in the low 200s. I just wanted to be long in Tesla, right? I bought the at the money straddle. I'm sorry, the combo. So I'm long call, short put, same strike, and I protected it. It's cheap. It doesn't cost you anything. Versus buying the stock outright. Are you kidding me? So
I think it's a great idea for a thesis like that.
Here's the NVIDIA version of it too. Right here, I did the same thing in NVIDIA from before. Same spread. You can see it right here. It's a great play, right? And look it's an opinion play. That's all it is. It's an opinion.
If you have a thesis like that, this is a great play. And also, but my caution here is buying premium for earnings. Like that's not usually an edge kind of play.
No, I agree with that. I think where I like to go, and that's why I like that double calendar. And if you're bullish, you can do one side of it. I can sell premium as a result of it. Sell front month, and I got to buy a little bit of Vega to protect it, but hopefully the combination of the two and the spread is big enough where it's not going to hurt me. As you can see, it didn't. And this thing's going back down to 139. So let's take a quick peek before we go on what that double guy is doing now. So the double guy is back to 183, right? The double calendar that I did, and it's farther from my 143 strike. So we've come down to the one, down a little bit. So this thing's still hanging in there. And had I gotten out of the other side, I might have a play to the downside here. Who knows? But that's that. This play I like better, probably if you don't have an opinion up or down.
Mm-hmm.
And Mark's, let's not forget Mark's value and opinion here. His opinion is don't play earnings, you retail people. Say it, Mark. Say it proud.
I would say my opinion is slightly more nuanced. Don't play earnings expecting to make money. Play earnings expecting to learn something about options.
Okay.
Or party. I thought he said party.
I thought he said party too.
Yeah. I said play earnings for a party. Have an earnings party.
Right.
Play earnings for a good
that,
time too. That's another perfectly valid reason too.
Yep.
Do you ever see the YOLO Wolf? I think it was a while ago. This guy and he got an inheritance and put it all on Apple earnings to be bearish. He bought like a whole like strip of puts, and the Apple went up, and he started throwing up in his mask. It was pretty funny.
Jeez, that's something. So, Mark, it's safe to say you're not doing any bots on earnings plays. The earnings bot doesn't exist, I'm guessing.
No, it's that's too well priced.
Sure.
I mean, I think you'd have to dig pretty deep into some earnings fundamental details to really find something that's truly mispriced.
Yeah, well, the other side of that too is, or not the other side of it, but another comment I'd make is everything's pretty well priced. Period. Right? Earnings are not. So we got to find our edge somewhere.
Totally. And I think that's why markets are amazing for risk transfer, is that they are efficient and well priced. That the idea is to, transfer risk at a fair price, not, some secret formula.
Yep.
I think the more liquid things are, the better they are priced. But I do think that there are times in which you can find, kind of like disconnections that you can, especially in lower liquid names in earnings. But in something like NVIDIA, Apple, the Mag 7s, the stocks with a ton of option traffic, I think it's very difficult to find an earnings edge.
Right. That's fair. Okay, cool. Anything else before we head out for the greener pastures of almost the weekend?
No.
Almost the weekend. I had such a good bottle of wine last night. We'll talk about that on another show.
Well, when you bought Tesla at 200, I can't wait to hear what kind of wine you're drinking these days.
Wait, by the way, where is Tesla?
Like
holy cow, 361. Woo! Mind-boggling. Going higher. I have another stock for us too. We talked about it last night at dinner, and I'm drawing a blank on it. Oh my god!
Is this an 11-year-old? An 11-year-old?
No, it wasn't 11. This was like a 65-year-old money manager or something like that gave me this one, but he's still not in it, even though it's moved from like $6 to $35. So I'll get it for next time. Just remind me, and I'll tell you what it is. But he still doesn't like it. I mean, he wants it back down at the $10 level. So I think he missed the move. I love those kind. I just need one of those. All right, boys. Have a good weekend. Good rest of the week. And if we're not happy, we're sad. So any other? Do you know anyone know Banges? Thank you, sir. Appreciate it. All right, guys. Well, you have a good weekend, and
thank you. Take care.
Yep, and happy trading, right, Mark?
Happy trading, everyone.
All right. Thanks, guys.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.